Hello and welcome to this video on accounting for leases. This is a rather technical topic within financial statements analysis within CFA Level 1. So we're going to discuss how leases are accounted for under IFRS, under US GAAP. We're going to do examples where we will explore the effect on various elements of financial statements using financial statement templates. If you're new to this channel, then a warm welcome. Please consider subscribing and hopefully also becoming a member to support the channel and get full access to all the videos that are available on it. Right, let's get cracking. So, leasing is basically an alternative to the outright purchase of an asset. And your book doesn't just discuss the accounting treatment, it also discusses the logic of purchase. It also discusses the logic of leasing as a way to finance assets. So in a transaction like this, you're always going to have somebody described as the lessee and the so-called lessor. And you need to know these terms because you may be asked to let's say, answer a question on the accounting treatment by one or the other, and these treatments do vary quite significantly. So the lessor is the legal owner of an asset. So this is the party that owns the asset. Now the asset could be anything. It could be a building that is being leased. It could be a vehicle like a car or a truck, or maybe a piece of machinery. Now the whole idea is that the owner, that's the lessor, hands the asset over. They don't sell it. They hand it over to the lessee, who from now on has the right to use the asset. So they can use the asset in exchange, of course, for payments, which they need to pay to the other side. So this is not for free. There are payments involved, $ over here. But, the lessee enjoys the benefits of the asset, whatever benefits that asset brings, without having to actually purchase it outright in the market and spend cash on it. Now, for a contract to qualify as a lease, and you have to know this, right? The book contains this definition. So in order to qualify as a lease for accounting purposes, the lease contract must, and there are three elements here that need to be satisfied. First of all, there needs to be a specific asset that's identified in the contract. Identify a specific asset, like a specific car that you have the right to use as the lessee, e.g. specific car. It's not about signing an agreement whereby you get access to use one out of a pool of similar cars over a certain period of time, or for, let's say, 20 hours during the month you can use a car, but you don't know which one it's going to be. Now it's got to be a specific asset as such. This also becomes quite important when you're analyzing contracts, for example, for the use of railway cargo rail stock, right? It has to be a specific asset as opposed to the use of some specific capacity. Now, on top of this, the contract has to give the lessee. Remember, the lessee is who's has the right to use the asset here on the left-hand side. So it gives the lessee the right to obtain largely all of the benefits, economic benefits from the asset over the contract term. So there shouldn't be, let's say, too many limitations. You kind of, at least for the duration of the contract, need to feel like you are getting what that asset has to offer, and it also has to give the lessee the ability once again, the lessee, the user, that is, the ability to direct how that asset is going to be used and for what purpose, for what objective the asset will be used. So as the lessee, I will be getting the benefits and I can decide how I'm going to use that asset. In that way, I really get the benefits of pretty much of ownership without having to purchase the asset outright, without having to spend the cash. And that is pretty much the main advantage of using leasing as a form of funding, of financing. So your book also lists the advantages of leasing, and these are, advantages of leasing as opposed to purchasing the asset outright. It requires either no or sometimes a little initial cash outlay. Sometimes you do spend a bit at the beginning, cash outlay. It should be cost effective. Why? Because ultimately it becomes a form of secured borrowing where the asset itself, the so-called underlying asset, is the security form of secured borrowing. If the payments, if you fail to make the payments as the lessee, well, then the lessor just comes and repossesses the asset. It's there. They own it anyway, so they take it away from you. And because it's a secured form of funding, the interest rate on it should be for sure lower than what you would get if you wanted to borrow money in an unsecured way and use that money to purchase the asset in the market. And your book also says, although this doesn't always hold in practice, that it is convenient. So there is a convenience advantage to it as opposed to purchase outright. Well, maybe. And also lower risk of certain things that would be associated typically with being the outright or owner. So if you own something, it may become obsolete. Here, you're not the owner. You just agreed to use it for a certain period of time and pay for it. So if the asset indeed does become obsolete, that's not really your problem. You just stop leasing it and move on to something else. Obsolescence. Okay, that's the difficult word I wanted. But asset obsolescence is just one of the risks that is characteristic or felt by the owner of something. Now, on to the really important stuff. From an accounting point of view, leasing can become quite tricky, and a lot depends on how the agreement is actually classified. And there are two broad classifications. Every contract may be considered to be either a finance lease or an operating lease. Now, this distinction used to be equally important under IFRS and US GAAP. It has now become a little bit more important under US GAAP rather than IFRS because IFRS standards have changed considerably. Nevertheless, as you'll see in a moment, there is not just disparity and difference between US GAAP and IFRS, there's also quite a lot of sort of ideological conceptual difference between lessee and lessor accounting. So unfortunately, there's a lot of stuff to learn here, which simply comes about from the standards not being, let's say, congruent on these matters, not being in line on these matters. Also, within IFRS, you've got completely different treatment for the lessee and for the lessor, which is confusing. Now, one thing to bear in mind is that if you come about, if you're thinking about how a certain contract and agreement should be classified, remember that being classified as a finance lease means that what the contract gives you as the lessee kind of resembles almost a purchase. So you feel as though you have an asset and you use it in a way similar to an asset that you would have purchased outright. You haven't purchased it because you're leasing it, but you feel almost like an outright owner, although you're really legally not. In an operating lease situation, it's going to be very different because your stance and the benefits and risks that you feel resemble much more an asset used under a rental contract, which is typically much more sort of short term and without subjecting us to so much risk. Now, the way we classify this stuff is as follows. The rules specify when you are dealing with a finance lease, and by the way, it has nothing to do normally with what's written on the agreement. The agreement could be called anything. It could be called a finance lease, operating lease, whatever, or the word lease doesn't have to be used from a legal point of view. What is important is that whenever you are using somebody else's assets and making payments for that use, so, this is something I crossed out here, the payments bit, but the payments are important, right? You're using somebody's assets and paying for it, and, a specific asset has been identified and the other two criteria have also been, are also satisfied. You've got yourself a lease, irrespective of what it's called in legally. And now you need to think about, is it a finance lease or an operating lease? And the way in which you distinguish between them is the standards specify the conditions for a finance lease. And if none of these conditions are met, you've got yourself an operating lease. So they don't even specify what an operating lease looks like. They say it's any lease agreement other than a finance lease. That's the way it is. So if any one of the following conditions are met, we've got a finance lease on our hands and we've got to deal with it appropriately, accordingly. By the way, until now, there is no difference between IFRS and US GAAP. It will come about later, right? So, if you've got an agreement where for now you're paying somebody to use their asset, but that agreement specifies that at some point there will be a transfer of ownership. So you're not the owner right now, but you will become the owner, for example, at the end of the agreement. The asset will legally be transferred to you at the end of the lease term. Treat that as a finance lease. Treat it as a finance lease because you already know the asset will become yours. So from the point of view of thinking about it even now when it isn't yours yet, you probably approach it and you handle it with the care and love that you would if it already was yours. In the same way, if, the lease doesn't specify that there will be a transfer as such, but it specifies that the lessee, that's the user of the asset, has the option. This is very often the case with cars. They've got the option to purchase the asset, typically at the end of the lease term, and we can be reasonably certain that they are going to do it. To do so, we've got a finance lease. Let me give you an example. Often, I guess this depends on country, but where I come from in Europe, when you lease cars, you've got an option to buy them out at the very end of the lease term. And if that price for which the asset may be acquired is at a good enough discount as compared to that asset's, let's say, forecast market value, you're probably going to use that right and exercise that option. In which case, you should already classify the asset as the contract as a finance lease, because for you, the way you approach the asset is similar to owning it. Even though you don't own it yet, you know that you will most likely become the owner at the end or at some point. Number 3, if the term of the lease is for, pretty much the major part of the asset's life, useful life that is, then even though you may never even become the owner legally, you are stuck with that asset for good, for much of its life, in which case treat it as if it's yours. I mean, from an economic point of view, it's as if it was yours. Number 4, if the present value, the PV, of those future payments, lease payments that you've committed to make, if that PV of those is equal to or higher than the fair value of the asset today, it means, by paying lease payments, you're going to kind of pay the asset off. And that means you're stuck with it pretty much for good. It's as if you're buying it with borrowed money. And number 5, if the asset has pretty much no alternative use to the lessor. So, the lessor is the party who owns the asset, but they've given it to you to use. But sometimes the asset will not be a universal one, like a truck, like a car, but something very specific, something very niche. An asset maybe that has been in some way modified to meet the requirements of the lessee, to fit into a production line, special machinery, etc. And if that's the case, and the lessor, if you stop making these payments, the lessor wouldn't have much of a use for that asset. The agreement will pretty much be designed in such a way to commit the lessee to keep paying for the asset for the duration of that asset's life, which means this resembles a purchase. So that's when you've got yourself a finance lease. An operating lease is going to be any lease contract which is not a finance lease. So no direct definition here, but simply if not a single one of these conditions are met, then you've got yourself an operating lease. As simple as that. Okay, now that's the sort of the theory over. Now we move to the more practical part here, which I want to explore via a relatively simple, hopefully simple example. So this is what I'm going to call lessee accounting. We're going to have to split this into 2 sections. This one's going to be devoted to how the lessee, that's the user of the asset, does their accounting. And, thinking about what you may encounter in the exam, I think this is where questions are more likely to appear, although you need to know lessor accounting as well, so you never know. Right, let's start with the IFRS approach and then move on to US GAAP. There is some convergence. Unfortunately, it's not 100% the same. Right, so under IFRS, we've got, and this has been the case for a couple of years now. It wasn't the case a couple of years ago. So if you're looking at a very old textbook for IFRS, you may still see the old approach. Don't look at it, right? What we've got is a single model for all leases, meaning irrespective of whether they would be classified as finance leases or operating leases, it doesn't matter. From the point of view of the lessee, we account for them in a single way. Although the distinction between operating and financing will matter from the lessor point of view and their accounting. Right, this single model is applicable, but there is an exception to it. Well, the exception comes in two ways, but unless the contract qualifies for an exception from the application of this single model, and that exception, I wanted to say and write exemption, to be honest, and I wrote exception, exemption. This exemption is for contracts which have been signed for no more than 12 months, so for a maximum of 1 year, or they relate to an asset with a relatively low value. And low value assets, your book talks about it, means maximum equivalent of $5,000. Although, because I'm also an accountant under IFRS, I can tell you that this isn't even written in the relevant standard. It's written in some implementation guidance. So it's not really part of the rules. It's just a guide. Anyway, your book treats this as if it was the rule. If you have an agreement for less than a maximum of 12 months, or it pertains to assets of a low value asset, then what you may do is you may choose to follow very simple accounting rules, may choose to account for the lease expense on a straight line basis. And in a moment, I'll show you what that would mean. Because here is an example that I'm going to use throughout the remainder of this video. It's a numerical example, and I'm going to show you the application of the rules under IFRS, under US GAAP, using this simple example. It's going to be a hypothetical 3-year lease for some asset. So this is the lease term. And let's say we're leasing, I don't know, a piece of machinery, whatever, it doesn't really matter at all. And we've committed to pay $402 of lease payments per year. And of course, given that this is a 3-year lease term, we multiply that by 3 to give us the overall amount. That would equate to 1,206 over the entire lease term. Before we proceed, right, because we'll need this in a moment, before we proceed with the numericals or numbers, I just want you to take the calculator, as I'm doing right now, and I want you to plug in the numbers and compute the yield on this agreement. Sorry, not the yield. We're going to compute the PV of the payments. Apologies. So let's compute the PV of those future lease payments using the TVM time value of money worksheet. Lease payments. Now, obviously, we need a discount rate to do this, but when you account for leases, you have to be given a discount rate. Assume 10% discount rate. So what we need to do is fire up the time value of money worksheet, clear it first, so second followed by FV, and now input the data. Well, we've got a 3-year term, so N is going to be 3 followed by N. Then I over Y is going to be the 10 that I just gave you over here. So okay, let me write this as I over Y equal to 10. Now PV is what we're going to look for. PMT is the 402 of lease payment every year. So 402 followed by PMT. And finally, there's no final cash flow at the end. So just leave FV at 0. If you've cleared the time value of money worksheet, you should be okay just leaving it blank. Or I always prefer just to type in 0 followed by FV to make sure there's nothing sitting there. And of course, I want you to compute the PV here. So CPT PV, compute PV. As you can see, my calculator now is showing something that's pretty much close to 1,000. Right, and I'm going to need this, right? I'm going to need this now to do the accounting for you or with you. So I'm heading over to one of these templates that I've got separately over here. And yeah, I'm going to start off with the approach under IFRS. But obviously this is IFRS, it's lessee accounting. But first, let's try to see what would happen if we applied that exemption that I talked about just a moment ago, right? If the asset is of a low value, if the agreement is either for a period of less than 12 months, which this one isn't, it's actually for a 3-year period, but also if the value of the asset is less than 5,000, and here I wrote, you know, we make 402 lease, but I don't know what the value of the asset is, but it doesn't really matter. Let's just see what it would look like if we had applied the exemption, if we were able to. Well, what would happen within your assets is cash would flow out basically every year, right? So let's draw little columns for year 1, year 2 over here, and year 3. And every year you would have an outflow of $402, $402, and another final 402 over here. And the only thing that would happen is, I mean, I'm assuming linear cash flows. If they were not linear, in the sense in some periods you would pay more, in some periods you would pay less, you would have to compute the average per year, and on a straight line basis you would recognize the operating under operating expenses, the relevant portion of that total payment. So 1/3 of it here, 1/3 corresponds exactly to what you pay on a sort of per period basis. So we would have minus 402, minus 402, minus 402, as you can see, straight line basis under which I recognize the expense in my P&L. That's what I was alluding to, and that's what your book alludes to when they say the issuer, the company reporting here, may choose to account for the lease expense on a straight line basis, which is typically also how you make the payments. But as I said, if the payments are not linear as such, you would still need to aggregate them, kind of think about what they're going to be in total, and recognize them on a straight line basis in P&L over the entire 3-year term in this case. Right, so that was the exemption, but what if we are not using the exemption? We're still doing IFRS accounting, so this is still IFRS, lessee accounting, but now let's say the proper full approach. That approach being what I wrote here, the single model that you're supposed to use, right? Now, you may want to make yourself a cup of coffee, a cup of tea, because you may need to re-watch this. I'll try to go in a very logical and sort of slow way, but it's not the most intuitive thing in the world. Your book has an example which is sort of in table form. I prefer to work with these templates of financial statements. I think it's more illustrative, but ultimately it may not strike you as the most obvious thing in the world, and you may need to rewatch this. So what happens as the first thing is, under IFRS, remember, it doesn't matter whether the lease would be classified as operating or financing or finance, same uniform approach. you recognize simultaneously two things, something within assets and something within liabilities. The thing that you recognize within assets has a very specific name. It's called the right of use asset, which your book abbreviates as the ROU asset. And if you really look into the financial statements of companies that use assets under leasing agreements, you'll see this ROU, not ROU, but right of use asset as a proper name. Within liabilities, you will create something called a lease liability. Lease liability. And initially, when you first recognize this, when you introduce these two items into your balance sheet, you record them at a precisely the same value. So this and this are, two parts, the debit and credit in what is otherwise the same entry. It's equal to the PV, the present value of those future lease payments. That's why I wanted to compute that PV before we dived in here, and I've got it right here. It's this 1,000. Obviously, we assumed a rate to compute this 10%. I use 10% to make our subsequent life easier. You'll see why. In reality, what you've got to use here is what's known as the rate of interest implicit in the lease, which is typically impossible to compute for the lessee, or so they have to use alternatively their normal borrowing costs as the discount rate. You don't have to deal with that, although your book does mention it, for no good reason, I think. Anyway, 1,000 over here, 1,000 over here. But that's just the initial sort of entry when the lease is commenced. What will happen next may strike you as odd. I will nevertheless walk you through it because your book requires you to understand this. So I'm drawing columns everywhere, 1, 2, and 3 for the 3 years, and I'll also do it at the level of the income statement because we'll be making plenty of entries over here as well. So what will happen in the first year? This asset will get depreciated. So let me write this actually at the top, maybe over here. The right of use asset, ROU asset, is subject to, well, I shouldn't really say depreciation because this asset is not the actual thing you're using. You've recognized an asset for the right to use something. So in fact, it's a bit of an intangible thing. The proper way to therefore to say what you're doing to it is that it's subject to amortization. So it gets amortized, and your book talks about amortization, not depreciation here. Right. So what I'm going to do is I'm going to assume this gets amortized on a straight line basis, although just like with any non-current asset, the way you amortize it should reflect the pattern of expected benefit flow to the company. Right? If it's linear, then straight line. If you take 1,000 and slash it divided by 3, you'd get 333.333 and so on. So I'm just going to do 3 here, 3, another 333, and then in the final year I'll do 334 to account for the fact that I don't want to have the 1/3 element. And this will go as amortization to the P&L in year 1. It's an amortization charge of 333. Nice and simple, and we'll repeat the same thing next year. Okay. What also happens in year 1, and it will happen in year 2, year 3 as well, is that we have to make that lease payment of 402. So here's, I guess, cash. And let's say that we have an outflow of cash for 402, which is the lease payment. And now the very abstract thing that needs to happen, and this is tricky sort of from a mental point of view, is You need to treat this 402 as if it was the repayment of a loan. Imagine, very sort of hypothetical loan repayment. Imagine somebody financed you for 1,000 and gave you a loan. If that were the case, you would need to pay interest on it, and you would need to repay principal, the capital of the loan. And what you've got to do, rather artificially, is take each of these annual payments, which are going to repeat at 402 per year, and break it down into a hypothetical interest and principal component. Now, year 1, year 2, year 3. Because for the first year, you were using an asset whose value was deemed to be 1,000, and the liability that you introduced to the balance sheet on the other side was 1,000 as well. Imagine what would have happened if interest had grown on that liability at 10% per annum. And I'm specifically using the rate which I told you to discount with. That's why I chose 10%, because it's easier to compute stuff without necessarily looking at the calculator all the time. So imagine that interest for the first year had grown at 10% of this 1,000. Well, it would have grown to 100. That's 10% of 100, right? That's from here. And if you're now making an end-of-year payment of cash, if this were indeed the payment of a loan, payment on a loan, it would include an element of interest and an element of principal repayment or capital repayment. If the entire whole payment is 402, that only leaves room of 302 for the principal portion. And what happens next is the following. Whatever is deemed to be interest goes to the income statement as an interest expense component. So that's the 100 I've got over here. And your P&L, the income statement, gets charged with two things: a bit for amortization and a bit for interest expense, the total being, of course, 433, both numbers being negative and both numbers impacting your profit in a negative way. And let's, not lose sight of the fact that whatever you do to your income statement has a direct impact on equity, because after all, the profit, whatever it is, gain or loss, gets transferred to equity at the end of the period. So, that 433 will also have a negative impact on equity. And whatever we deem to be the principal portion of the payment reduces our lease liability. It's very tricky, but this is how it works. Now look, as a result, your asset, which began at 1,000 at the beginning of the year, has dropped by 333 due to amortization, so has gone down to a level of 667. That's the sort of net carrying amount of the asset due to amortization. Cash has also sort of left the business, and when you combine these two downward movements that happen, you get a total of, 333 and 402. That's going to give us a total downward movement of 735. Now let's have a look on the other side of the balance sheet, equity and liabilities. The stuff that went to P&L, 433 in total, impacted equity in a negative way. And we also said that 302 is the repayment of principal. Well, kind of in quotation marks, because we're not repaying a loan, we're paying on a lease, right? But that's how the accounting goes, as if it was the repayment of a loan. And these two things combined, 433 and 302, give 735 as well. Unfortunately, what we did on one side of the balance sheet matches with what we do on the other, so brilliant. Now, year 2. In year 2, we have another portion of asset amortization, which, just like before, impacts our P&L, our income statement, but this is now for year 2. Cash, well, actually, let's stop over here and have a look at the assets value. If this was 667, if you deduct 333, it actually now stands, the balance stands at 334. We have another reduction in cash of 402. So as you can hopefully see, when I combine the movements that happen on the asset side, they will give another 735 downward change, a drop. But for the second time now, I have to dissect this payment into its hypothetical interest and principal components. Those components are not going to be the same, because the trick is, assume that the interest is charged on the liability that's still left outstanding. And if we assume that during year 1 or at the end of year 1 there was some repayment of the liability, it will have dropped. It began at 1,000, it dropped by 302, so the balance at the end of the year must have been 698. And the idea is interest relevant to year 2 should be computed on the base of the balance outstanding as at the end of the previous year or beginning of the current year. So once again, I take this and multiply by 10%, but now it's going to, of course, give a lower amount. In theory, I should write 69.8, but I can't be bothered with the little bit after the decimal point, so I'm just going to say over here 70. Rounding it up a little bit. The goal is to account for the entire payment of cash, which is 402. And the only way to reconcile this is to say, well, this time around the principal element must be equal to 332. There is no other way to work these, right? Work these sums. Right. So whatever is deemed to be interest goes to P&L, just like before. It's going to be the 70 this time. And when you add the amortization and the interest expense, you get yourself a 403 downward negative impact on P&L. So look, this 403, just like before, impacts our equity. Obviously, it's a different figure now, but it goes to equity. And whatever was deemed to be the principal component reduces the outstanding amount of the liability as reported in the liability segment of the balance sheet. So if we had 698 over here, a reduction by 332 is going to result in an end of year balance of 366. Please appreciate that combining the move in equity and the move in liabilities, both moves being downward ones, so 403 and 332, we get another batch of 735 downward movements, which is brilliant because that's the same as the movement on the asset side of the balance sheet for the same period. And now we come to the final year. In the final year, we have the last portion of amortization, and because I rounded the amortization charges in the previous 2 years really downwards, they should have been 333 and 1/3. I now need to make the final one a little bit bigger, 334, which kind of disrupts the linear nature of this, but hopefully you understand where this comes from. The cash payment is once again 402. So, unlike in the previous years, the total movement on the asset side will be 736. Of course, our asset is completely depreciated. It has a carrying amount of 0. And for the last time, I want you to think about how this move or how this payment could be broken down into its respective interest and principal components. To compute the interest element, we would need to apply 10% to the balance outstanding as at the end of the previous year. So that was this 366. And I'm now, because previously I rounded up, I now need to round a little bit down. So I'm going to make this 36. And of course, the total payment is still that constant 402. If you take 402, deduct 36, you end up with a residual here of 366. The idea is that always the sum of these two components should equal 402. This becomes the interest which we recognize in P&L. This becomes the drop in the liability. So, going to P&L in the column for the third year, obviously I must first account for the amortization, 334. The interest element, 36, that I just computed down here. So the total negative charge to P&L that we experience is 334 plus 36. Okay, it's going to be 370. That goes to equity as always, impacts equity downwards. And this 366 from over here is what we need to reduce our liability, which goes down all the way to 0. Now for the last time, let's just check what happens when we add the two movements that happened to equity and to liabilities. That's 370 plus 366. Well, it's a total of 736 downward moves, which is exactly the same thing as we did for assets. And this is how you account for the lease under IFRS. Over time, both the asset and the liability drop down to 0, but they don't do it in the same way. The asset is subject to amortization, whereas the lease liability, well, here you need to apply the so-called effective interest method. An effective interest method is basically applied at 10% to compute the interest expense that goes to P&L, treat everything else as repayment of principal, and you will ultimately reduce the liability down to 0. Please also note that when you sum, I'm going to take my calculator for this, when you sum all the charges that went to P&L, which were distributed among amortization and interest expense, 433 plus 403 plus 370, you arrive at a grand total for the 3 years of 1,206, which is absolutely equal to the sum of the cash outflows, the lease payments. Except that, when you do things under the exemption, the stuff that goes to P&L is also a total of 1,206, but it gets put into one line called operating expenses, or lease expenses within operating expenses, and it follows a linear pattern whose sum is 1,206. Here we do it in a non-linear way, and we spread the expense among something called amortization and interest expense. So I'm back on the note because I want to kind of take stock of what we've just done under the sort of full IFRS approach, make some notes on it in case you get theoretical questions on it. So let's say these are the features over here of the IFRS approach. But this is not the exemption, this is sort of the full approach, right? And we'll take it in turn. First examining what happens on the balance sheet, then the P&L, but also I'll tell you about the cash flow statement. So balance sheet first. Remember, we're talking about the lessee, the user. They will have two things: the ROU asset, so right of use asset, where we are deducting accumulated depreciation all the time. Obviously, the starting point is the PV of the lease payments, but then we deduct subsequently accumulated depreciation. And on the other side of the balance sheet, you'll have that lease liability, where sort of the starting point is the same under both approaches. It's that PV of the lease liabilities, but here we are deducting, and I'll put this in inverted commas, the principal repayments. Although when you get an invoice, it doesn't say principal repayments, it doesn't say interest, it just says, oh, here's your annual lease payment or monthly lease payment, and in your books you have to make that rather abstract split, which I can tell you is, for many accountants, is a big sort of headache. Now, in terms of what happens in your P&L, well, like you saw, within P&L there are two lines that get affected. We've got amortization expense, and separately from that, we've got the interest expense. And everything connected with the cost of that payment, of that lease, in total, we spent 1,206 in total payments. And that was also recognized in P&L over the 3 years. But it goes via these three lines. And I want you to be aware as analysts that this has huge repercussions for a company's EBITDA. Because if you are looking at a company's performance via the sort of prism of its EBITDA, earnings before interest, taxes, depreciation, and amortization, then because this whole payment is split into interest and amortization bits, this whole expense, it will not be captured at all within the EBITDA measure of performance. So watch out. Companies that lease a lot under IFRS will have a much better EBITDA due to this, and you have to find a way to sort of account to adjust for it. Or anyway, but you've got a liability sitting in the balance sheet at least. Now, in terms of cash flows. In the cash flow statement, whatever was the principal payment, so the bit that was reducing our liability every year, right? This bit, which I termed 302, 332, 366, which I called the principal, that goes under IFRS to your cash flows from financing activities, obviously as something negative, as if you were repaying a loan. The interest component, well, I wouldn't say this is payment, sorry, let's call this the component, because this is something we artificially compute, right? Splitting the overall lease payment into its principal and interest components. This one, remember, this is IFRS, and under IFRS, when you pay interest, or something that you call interest, you've got a choice of how to account for it. You can account for it either within CFO, cash from operating activities, or within cash from financing activities. It's up to the company to decide which it wants. Depends on the accounting policy choices made by the company. Right. Okay, I think this should give you enough confidence, maybe you need to rewatch it, to answer questions on this topic. Now, let's move to the second one, that's US GAAP. We're still talking about accounting by the lessee, by the user, right? And under US GAAP, there isn't a single model. By the way, there is an exemption. You can use the straight line approach for leases. There are maximum 12 months, so they've got that exemption. But other than this, but there isn't an exemption for the low value assets. That's only IFRS specific. So leases will absolutely you will need to split them into the finance type and the operating type. And here it does matter. Like under IFRS, I said the approach is uniform. So the split doesn't matter if you're a lessee. But if you're a lessee under US GAAP, it does matter. For a lease qualified as a finance lease or classified as a finance lease, you'll be happy to know that there is convergence with IFRS. So the approach is identical to IFRS. Okay. For operating, unfortunately, it is different. And it's different in a way that in the end, you'll see that it's actually quite easy. Unfortunately, nothing is really easy here. So I'm going to have to explore this approach with you, and you'll draw your conclusions. So what I'm drawing here, or what I'm writing here, is that we're exploring a US GAAP, the US GAAP approach. We're still looking at the lessee accounting, but this time we're saying it's an operating lease. Because if it were a finance lease, it would be like the approach under IFRS, which I've already shown you. Right, so initially, things are exactly the same as they would be under the finance lease approach or under the IFRS approach. You recognize the ROU asset, the right of use asset, and a corresponding lease liability, right? So using the approach we had before, that would have been 1,000, because that is still the PV, the present value of all the future lease payments, discounted using, some assumed rate, which if you need to do this in the exam, you'll be given. Don't worry about having to kind of find this out yourself. Now, as you can see, I'm making the columns for years 1, 2. Well, that one's a little bit thin here. Sorry, 1, 2, 3. We are going to need these. Okay. What happens next is quite strange, because this asset will get amortized, but the number one thing to remember here is that the ROU asset amortization isn't going to be your sort of straight line amortization like before, where it was going at 333 per year, right? The amortization of the asset is going to be equal to the lease payment minus the interest component contained in it. And if you deduct the interest component from the lease payment, you arrive at, well, basically the principal component. So that is going to lead to to some very interesting effects. Well, very interesting if you're an accountant. If you're not an accountant, very weird and actually completely abstract. Anyway, what happens to cash? In the first year, we spend our first bit of cash, so 402 leaves the company. Remember, that was the annual payment. And just like before, we have the job of dissecting this into two hypothetical components, one being the interest component, the other being the so-called principal component. And the rule is exactly the same as we had before. So interest is going to be computed on the balance of the lease liability from the start of the period. So if that's 1,000 times 10%, 100. Obviously, we're paying for 402 in total payment. So the principal bit has to equal 302. So let's do it again. 100 interest. Take that to P&L minus 100. But don't call it amortization. If it's US GAAP and you're accounting for an operating lease, this will be called the lease expense. Okay, fine enough. This principal component, like before, reduces the balance sheet value of the liability, making it drop to, well, 698. Like I told you, account for the amortization of the right of use asset, but make it equal to the size of the lease payment, 402 in the first year, the size of the interest component, 100, which leaves us with 302, which is the same as the principal bit. So this amount of principal reduces the liability and the asset as well by the same amount, 302. So at the end of the first year, the asset will be worth 698 in our books. That's going to be its carrying amount, and so will the liability. Now, this amortization, which is equal to the principal repayment, also goes to the same line within P&L. It doesn't go to any separate line. So within P&L, you've got a total charge of 402, which, by the way, is the same as the cash paid. And that naturally goes and impacts our equity negatively. So as you can see, hopefully, what we do to assets, 302 and 402 down, a total of 704, is exactly the same as the overall decrease to equity and liabilities, making our balance sheet fall in line, or keep its balance. Now, in the second year, we will pay another batch of 402, and once again, we need to decompose this into interest and principal, and it's going to follow the same rule as before. We take whatever was the previous balance of the liability, apply the interest rate to it, the effective interest rate, which is 10%, and we get something like 70. I'm following the same logic as for calculations as before. And because the overall cash payment is 402, well, I need to find the missing figure, which naturally is going to be 332. So this logic of dissecting the payments is exactly the same as before under IFRS, under the finance lease example. Right, okay. So, like we said, whatever is considered to be interest goes to P&L, but not under interest expense, under the lease expense. Whatever is considered principal impacts the liability, but also this time the asset. So the difference is that you don't amortize the asset in some specific way, like straight line. You reduce the right of use asset by exactly the same amount as you reduce the lease liability, meaning that what you've got at the end of the year here is going to be 366, and that's going to be the same as the carrying amount of the asset. And of course, whatever you took to the asset as amortization also goes to your P&L. So this time your P&L is impacted, well, hey, for again 402, which is the same amount that left cash. Right. And finally, in the final year, we charge interest at 10%, but of this final amount here, this 366, and this would be 36.6, which I'm going to, just like before, round down to 36, and to get to a total of 402, I would need to imagine that this is 366, right? The 36 is the interest component. That's what goes to my P&L. The 366 reduces my liability down to 0 and my asset down to 0, because both had a balance of 366, or balances of 366 the last time we met them. And of course, This 366 also impacts my P&L as sort of the amortization component, but it goes on into the same line called lease expense. 36 plus 366 is, once again, 402. And of course, all the time we're also impacting equity. But as you can see, I mean, whatever you do to equity is what left the company as a cash flow. And whatever you reduce the asset by is also what you reduce the liability by. So the balance sheet really does balance after each of these years. Back to my note, and let's jot down a few things about this approach, because actually it's easy to get confused here. So if it was a finance lease, you would do exactly the same thing as under IFRS, and you may have already forgotten what we did a moment ago, but you can go back and scroll back on this video. It's probably one of the longest videos ever on the channel, and it may hold that record, but it's really important. And I didn't necessarily want to split it up into more than one. You just have to get through this, right, with enough coffee, tea, whatever. Right, in the balance sheet, then, of the lessee, we've got the right of use asset. And this is held at the initial present value of the lease payments minus accumulated depreciation, well, not depreciation, amortization. In terms of the lease liability on the other side of the balance sheet, well, the starting point is the same, and then we deduct principal repayments. But because these two are the same, like I showed you, the ROU asset should at any point in time be equal to the lease liability. And this is something that you only get with an operating lease under US GAAP. Right, so that was the balance sheet. Within P&L, you only have a single line. That single line is called lease expense. And into it, or to it, you take both the interest expense and the ROU asset amortization, which also equals the principal payment, principal repayment component, right? Which means that the lease expense which you report in your P&L is going to equal to the actual lease payment made. Like you saw in my example, every year the sum of this lease expense was the same as the cash leaving the company. That's the way it's designed to be. And please appreciate, if you can get these questions are tough because you need to understand these approaches. But under this way of accounting, the interest expense and the amortization go into a single line called lease expense, and they're not reported anywhere separately as a true interest expense or a true amortization charge. So don't look for them elsewhere in the P&L, and therefore EBITDA will absolutely feature the lease expense as one of the operating expenses, and therefore will be lower in this case. It was higher under IFRS or a finance lease under US GAAP because there everything is called interest expense or amortization, and therefore is out of the EBITDA approach. Now let me just make a bit of space over here. We've had P&L, we've had the balance sheet. Actually, no, let's not confuse things. Let me just continue on to the next page and say what happens in the cash flow statement. in the cash flow statement, we're going to have the entire lease payment reported as cash flow from operating activities, and there is once again no separation into respectively interest, principal. Just take everything to CFO. Right, and if you thought this was it, it's not. There's another bunch of rules that you need to know. This is tough. I did say it would be for the accounting done by lessors. Fortunately, I don't think it's hardly as likely that you'll get asked on this, but you need to know. Lessor accounting now. So we're looking at the other side, the owner of the asset. Well, the good news is, even though it's not exactly true, your book says IFRS and US GAAP are practically the same. Well, this is true. They are almost the same. US GAAP rules are a little bit quirky for lessor accounting, but and you used to have to know the specifics for US GAAP. Nowadays, the book says, or the curriculum says, from an analytical perspective, they're practically the same. So you don't need to learn, two sets of rules. Great. So you do, however, need to appreciate that both under IFRS and US GAAP, it matters whether we're dealing with a finance lease. So, although IFRS has a single model for leases, be they finance or operating, if you're the lessee, that doesn't apply to lessors. From the perspective of the lessor, it does matter whether you've got yourself a finance lease or an operating lease. So, if it's a finance lease, it means that the other side, the lessee, should recognize the asset, the right of use asset, in their balance sheet. You remove the leased asset from your balance sheet. Actually, what I said just a moment ago doesn't really make that much sense, because under IFRS, every type of lease results in the lessee recognizing an asset. But here, if it's a finance lease, so forget what I said before. If it's a finance lease, the lessor removes the asset from their balance sheet, so they de-recognize the asset as if they sold it, although legally that's not the case, but they've sort of relinquished the benefits and risks associated with it. And instead, they recognize what's known as a lease receivable. That's obviously the opposite of a payable. It appears under assets. So one asset disappears, another asset, sort of financial asset, appears. This is equal to the PV, the present value of future lease payments. But because you are the lessor, you're going to receive the money in the future. And it's a bit like a bank recognizing a receivable from loans made. Pretty much the same stuff. Now, this lease receivable subsequently lives or behaves like a classic financial asset, like a fixed income asset. So what you need to do is you need to use the effective interest rate. And you can go back to videos that I did on accounting for financial instruments, where I show you how the effective interest rate method is applied, where each payment received essentially gets split into an interest component, which goes to P&L as something positive, and the principal component. It's a bit like accounting for a bond, essentially, and the principal causes the receivable to drop. I don't even have to, I don't expect you to have to do this. So, in the balance sheet, the lessor has a lease receivable asset, which goes down as repayments are received. In P&L, they recognize interest income, just like a bank recognizes interest income on loans made. And in the cash flow statement, you show the inflows as CFO, the entire payment. Now your book also says that if it's the company's primary business to be a lessor, then probably this interest income will be actually shown as the top line, as revenue, because making this type of income is your sort of primary way of generating something positive. On the other hand, once again, we're talking about lessors, right? If the lessor is involved in an operating lease, then this gets treated as if you were the owner of something that you're renting out to others, so treated like a rental agreement. Just because you're renting something out to others temporarily doesn't mean that in the balance sheet you should remove it. You haven't lost control of it. So in the balance sheet, the lessor still continues to recognize the asset, continues to keep the asset in their balance sheet, recognize the asset. And what follows from that is you depreciate it as well, to recognize the asset and depreciates it normally, right? Within P&L, what they'll have is anything that flows in from the lessee doesn't get split into a principal repayment component and an interest component. No, here you just take the entire inflow as lease revenue and recognize it on a straight line basis, just going to P&L. And of course, you've got the depreciation also happening, but that's a negative item within P&L, whereas the lease revenue is positive. And in terms of cash flow, and this is going to be the last thing, you report it as CFO, the entire payment. So at least in this respect, it's like a finance lease from the perspective of the lessor, because at least this component, like here, plus everything going as a plus to cash flow, cash from operating activities, was the same here. Now, look, I know this is complicated, and it is one of the most demanding sections of the FSA curriculum, which itself is quite demanding, right? But please take the time to study this video again. Focus on lessee accounting primarily. That's the one I think that has most chances to get tested. And even if it gets tested conceptually, theoretically, I'm sure appreciating what happened over the course of these examples will help you get the points here.